Hello, everyone, and welcome once again to my YouTube channel. My name is Miracle Naji. One question I do get a lot from founders and from some people starting out their careers in venture capital is how do VCs value startups? Now, this is a very, very critical question because a lot of times I see founders coming up with crazy valuations. Now, whilst it is desirable for you to have a high valuation, but also know that sometimes it may be the reason that is stopping you from raising. So in this video, I'm going to be covering 8 different considerations that VCs make when valuing startups. Because honestly, when it comes to early stage investment, valuation is more of an art than it is of a science. So you really want to know what are those different components of that art. So without any further ado, let's get started. Okay, welcome back. And today we are going to be talking about valuations. Like I mentioned earlier, valuation is more of an art than it is of a science, especially when it comes to early stage investment. Reason being because at that particular point of where the company is still early stage, the risk of failure is very, very high. So there are very, very little tangibles to tell about, okay, that this company is going to succeed, unlike more mature companies with some sort of traction and maybe revenue history, financial history behind them. And then you can be able to use that to make a realistic forecast. Again, for some people using discounted cash flow and using that as a basis for valuation. But it really doesn't work like that for early stage startups, right? Because of a whole lot of factors from the risk involved of them failing, of them not succeeding. Some of these things tend to affect a lot when it comes to valuing startups. So for that reason, when an investor's perception of risk in a particular investment is low, they tend to value the startups higher. And those factors could be anything. It could be from the track record of the team. It could be from, let's say, certain strategic partnerships, certain unique technology that the company has that gives the VC an indication of value. So these are some of the considerations that they do make. But without any further ado, let's look into 8 critical things that investors look at, that venture capital firms consider when they are valuing early stage startups. Okay, so the first one I'm going to be talking about is the stage of the company. The stage of a startup is very, very critical when it comes to valuations. Now, in one of my videos, if you've not checked out that video, maybe I'll drop the link somewhere here about the different stages in the startup growth process. That many startups, you have them at the pre-seed, and from pre-seed, they move to seed. From seed, they move to Series A, from Series A, Series B, Series C, and Series D, and so on and so forth. Now, across each of these different series, there are certain key milestones that is expected that the startup is going to be seen, that the startup is going to reach in order to give the VC a sense of value in that particular startup. So the way a VC is going to value a pre-seed startup is going to be different from how they are going to value a seed startup. So for a pre-seed startup, for instance, they are mostly in their MVP stage. Most times they're mostly in their MVP stage. Sometimes they've not even launched the MVP yet. Some of them are even still at that conceptual stage, right? So at that particular point in time, there's really no traction. There's really nothing to base, let's say, any projection of what the business is going to do. So mostly there are certain things that now comes into consideration, like the team, the market potential, right? And then there are certain standards as to what the typical valuation of an early stage startup is going to be, of what a growth stage startup is going to be, or what a late stage startup is going to be. There are certain ranges, right? So mostly for pre-seed startup, you see their, especially within this area, especially within Africa, that their valuation is usually less than $2.5 million. So some VCs may have that as a working principle when they are looking at valuing a startup, right? And then for seed stage startup, mostly VCs will want to work with a cap of like $10 million, right? For seed stage startup, especially again, this could vary based on the region, it could vary based on the geography. But for this part, you see most seed stage startups are valued like less than $10 million, right? And this tends to go up when it gets to Series A, Series B, Series C, and the rest of them. So the stage of your company is very, very critical. In that video, I also mentioned what the typical valuation range would be for a pre-seed startup, a seed stage startup, and so on and so forth. Then the second one is how competitive is the deal. The truth is when most VCs, they tend to have this sort of fear of missing out, especially when they come in contact with a huge opportunity that they see a lot of potential, right? And when other investors, other venture capital firms also want an allocation in that particular deal, it tends to drive up the competition for an allocation on the cap table of that startup. Of course, when the sort of when supply is high but demand is quite low, of course it tends to drive up tends to drive up value for the startup. So when your investment opportunity is one that is very, very competitive, it gives you a better bargaining leverage to increase your valuation. Then the third consideration that is being made is the experience and track record of the team. The experience and track record of the team is very, very, very important. Remember, like I mentioned, that most times when VCs are looking at startups, they look at it from a risk perspective. So anything at all that tends to ameliorate that fears of risk, it tends to give the VC a comfortable position to value the startup high. So for instance, now let's say the founding team, they are well experienced, well established founders. Let's say they have exited one particular company before and returned several millions of dollars to investors. So the VC has confidence that this is an experienced entrepreneur. They can be able to execute on whatever business idea that they have. And also it gives them confidence that they're able to attract funding from other venture capital firms, right? Because if you've run a business before, you've raised money from investors before, chances are that these investors will be able to come back to back you up. So for such startups with an experienced team, VCs will tend to value them higher than when they are dealing with a newbie startup that is just starting out, no experience, no track record. So in order to compensate for the high risk, they would want to crash down the valuation so that their ownership in the business tends to increase. Then the fourth one is in terms of market opportunity, size, and trend. Now, especially for early stage startups, that most of the time what the VC is betting on is the the market opportunity that exists within that particular industry. So for certain industries whereby they see a huge market opportunity, where they see huge market opportunity in terms of what the products could do if they execute, if they succeed, you see that the VCs will want to value that particular startup high. And then also certain industry trends. So for instance, now at this point in time, artificial intelligence is like the in thing. Everybody's going into AI. Everybody's looking at that next startup that is going to lead the pack when it comes to AI. So because of such reasons, VCs are very, very keen about AI startups. Once you say that you are leveraging AI to do A, B, C, D, they are interested. And then do the thing when you have solid technology to back that up. So they are going to value you high. So the market opportunity and the different trends are some of the considerations that VCs make. Then the fifth one I'm going to be looking at is the VC's investment approach. So some VCs just has it as a rule of thumb to say that they only invest in startups that has a valuation, their valuation is $10 million or less. Right. So if you are coming to the table and you are valuing your company at $15 million, at $20 million, then clearly such a VC is not your target market. So you want to look into that particular VC to know what their investment approach is and see if it aligns with what you truly believe that is the value of your startup. Right. Then the next one is in terms of traction and key milestones reached. This is very, very much important. So the more traction that you're able to see, the more milestones you're able to cross. It shows the investor that you're onto something. It shows the investor that okay, you can be able to execute on your business idea, and it gives some much more confidence, right? To say as a seed stage startup that you have been growing your monthly recurring revenue, let's say by 20% over the last 24 months. Right, over the last 24 months, it gives them confidence that there is more growth to see in this particular business, or to say that your user base has been growing by 10x on a year-on-year basis. So such traction gives the VC confidence that okay, you are doing something right. Also, one especially for growth stage startups, one thing that is very critical for VCs is understanding your business model. That you have been able to find a business model that can scale, and that business model has also been able to your product has also been able to achieve product to market fit. Now, this is very, very critical because it shows them that you are now on that path to growth, and then there is a clear path to profitability. So when that is not there, it means that you are not doing something right. So they will want to value your company lower, right? So when you consider the traction and the key milestones that you are seeing, it helps you to build a case as to why you command such value. So let me give another particular instance. Now, post the market's contraction since 2022 due to tough macroeconomic conditions. Now, VC start applying a rule of thumb as to how the value startup to say. So, for instance, like 10x of your revenue is going to be the valuation of the company. So if you are valuing your company at $10 million, you better have the revenue to back that up. So it's expected, like for instance, if they are doing 10x of revenue, that you are doing about $1 million in revenue, right? And very rarely do you find seed stage startups at this particular side in this region doing up to $1 million in revenue. That startup must be really doing something very right, right? So the traction that you're seeing and the key milestones that you've reached, and that milestone can be like, let's say, a key partnership that you've been able to sign a key partner, and that key partner can be able to take you from point A to point B. I also use an example of a particular startup that I looked at. Now, at the time where we were looking at the startup, they were doing about $6,000 in terms of sorry, they were doing about $33,000 in terms of monthly recurring revenue. But then they were able to onboard one particular partner, a key partner that jacked up their revenue from that $36,000 to about 50 something thousand dollars in revenue. So you want to be able to see such partnership. It helps you make more case for why your company is going to be valued high. So the traction and the key milestones that you are seeing very, very critical to building that investor confidence that you are valuable and they want to price you at the high valuation. Then the seventh one that we are going to be looking at is the prevailing economic conditions. So the truth is that valuation tends to go hand in hand when it comes to the prevailing macroeconomic conditions. At certain times when there is a market boom, right, then valuations are high, right, because capital is abundant. And because capital is abundant, most people are able to raise funding at a lower cost of capital, and then they can be able to jack up their valuations. But that is not usually the case, especially when we start experiencing certain market correction due to, let's say, recession in the market. So you see that the valuation tends to dip. So I'll give an instance. I think Stripe earlier on in 2023, they raised the funding that they raised in January 2023. They raised the fund at a down round. So prior funding round was about $90 billion, and that one was like 60 because the market was down. So prevailing market economic condition can really affect the valuation of your company per time. So the last one we're going to be talking about, and then I'm going to wrap it up, is technology and whatsoever IP content that you have. So remember, VCs are looking for something that they can hold on to say, okay, this is the value in this particular startup that I want to plug in my money, especially for early stage startups. So as an early stage startup, if you built a unique technology and that technology has been patented and you have the IP rights to it, it gives the VC confidence that, okay, there's something of value here. And it also depends on how unique is that technology. If it's something easy for somebody else to just come into the market and then just copy it out, right? But if your technology is very, very unique, then it gives the investor a sense of value. So these are some of the 8 considerations that VCs tend to make when they are valuing startups. Now that is for the art part of things. So there's also the science of valuation as to certain numbers, certain quantitative aspects that are being brought into play in order to value startups, from some sort of modified DCF approach, the venture capital approach, and then some other approaches that are used to value startups quantitatively. In my next video, I'm going to be exploring some of those approaches just to help you have a well-rounded understanding of how VCs value startups. So if you find this video useful, please leave a like, subscribe, turn on your notification button so that you get access to other subsequent videos that I'm going to be making. So thank you very much and see you in the next video.